Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
So this is episode number 2, and we'll talk more at the end as well, but our goal is to meet the first and third Wednesday of every month and have a version for syndicators and a version for passive investors. And the goal is really to focus on how to get from 0 to 1, meaning getting your first syndication either as a syndicator or get into your first passive investment. Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice. So to start off, my name is Marcelo Cazini. So my background is in IT and management experience. I have an MBA from Texas A&M. I'm also part of the CCIM local chapter here. I completed all the CCIM designation trainings. I am a multifamily investor. I own and operate my own commercial real estate business. And prior to multifamily, I was also involved with single family fix and flips. And then we'll have Claudia and Martin introduce themselves.
Yeah, I'm gonna go first. So I am a real estate professional, and I have a degree in architecture, and I have a background in asset management back in Colombia, where I was born. And currently, I hold a National Apartment Association certification. It's called the Independent Rental Owner Professional certification, and I am doing multifamily full-time.
And I'm Marcelo Rubio. I'm an IT security consultant. I've been doing this for over 24 years, both in corporate America and in my own consulting firm. My background is basically that of consulting and that of managing our own businesses with Claudia on consulting and hard money lending and real estate in general. We have invested in over 400 units passively, and now soon another 100 plus units as a general partner.
All right, perfect. So Michael, do you want to go ahead and introduce yourself?
Yeah, sure. I'll do a brief introduction. But yeah, first of all, thanks for having me. I appreciate that. I'm Michael Lee. I live in Houston. I'm a full-time investor, and my background's in IT. And for about 12 years, I had my own consulting firm. And then about 5 years ago, I realized I didn't want to do IT anymore and started pivoting into real estate. So as of right now, I've done about $35 million multifamily transactions, raised about $13 million in syndications. I've bought 6 apartments, sold 1, so I still have 5. And then I'm also pretty active as a passive investor, and I've invested in 20 properties as a passive, total of 4,500 units or so, thereabouts. And also doing some development, mixed-use development right now in the commercial side with retail storage and multifamily.
We'll start when you were at 0, Michael. So when you were at 0, before you started doing multifamily, what did you do? If you go a little bit deeper into what you were doing on your life before real estate, on your IT background or anything else you did, and maybe tell us a little bit on how you got that first approach into real estate or multifamily.
Yeah, sure. So I've had interest in real estate for a really long time, actually. I mean, for going back into late 90s, early 2000s, I was already going to, different RIAs and meetups around the city of Houston. I'd go to a lot of these meetups. I'd sit in the back, listen to everyone talk, and then go home and do nothing. And I think there's a lot of people that probably can say the same and fell into the same trap of just overanalyzing and not doing anything, right? Analysis by paralysis, right? So I did exactly that. Being too much of a logical thinker, being in IT, I would always overthink things and said, if I only knew this, I would start. And I don't know that, so wait until I learn that before I start, and I just never started. And then I started my own IT company back in 2006, and that went well. So kind of real estate kind of faded away. It wasn't as urgent for me until I decided I didn't want to do it anymore, and started trying to figure out how to get out of it. So I started pivoting about 5 years ago into real estate because I figured there's something I could do long term away from my IT. And I started with single family real estate, which I think probably a lot of other people do start out with, just because frankly, I didn't know what else was possible out there. I mean, single family is the most attainable financially and mentally for a lot of people. I mean, this is an easy concept. Most people own houses. They've lived and grew up in houses. So it's something that is doable. So that's kind of how I started. I started doing single family.
Okay, and then that transition from single family to multifamily, how did that happen?
Well, I mean, I was looking at it and seeing exactly what my goal was in terms of my end goal, and was measuring it against my progress in the single family, and came to the realization that I had a long way to go on the single family side, and it wasn't going fast enough. It wasn't scaling enough, and I had done well for myself in my corporate career and with my own company, and I had the capital to move forward, but just wasn't doing my single family fast enough. So started trying to figure out what else was out there. So that's when I ran across multifamily.
Did you run across any other things like other commercial type of properties or anything like that, or just you found multifamily and you fell in love with it right away?
I mean, I looked at other assets to some extent, but I mean, I think going back to what I mentioned before about being attainable mentally, I think multifamily is, like probably a lot of other people. I mean, I've lived in apartments. I understood what that means. I've never owned a warehouse. I've never lived in a mobile home park. I've never rented self-storage. So those were things that weren't as familiar to me. So multifamily drew me because of that. It was something that I was more familiar with.
Okay. I think Marcelo is going to continue from now, not from zero, now how you got from 0 to 1. Go ahead, Marcelo.
Yeah, exactly. So as you look now, you decided to start with multifamily, right? So now, did you feel like you have to make any changes to your life in terms of going to that path, in terms of your financial situation, your mindset, your routine? Talk to us about what changes that you implement to go from that 0 to the first deal.
Yeah, absolutely. I mean, I think for me, mindset, as I mentioned, I mean, I've been looking in real estate for the longest time. And I mean, back then I would show up on Saturday mornings at 7 a.m. or 8 o'clock a.m. at these meetups and sit there for 2-3 hours and then go home and do nothing. And it was not that I didn't have the ability, not that I didn't have enough money or wasn't smart enough, but just mentally I wasn't in the right place for it. And I think a lot of people get caught up in that. So yeah, I think mindset was a big thing. And once I got myself in the right place mentally and that I could do it, that definitely helped. And in terms of giving up things, I mean, I think it's a tough business. It's a lot of work that we put into it. And so there's definitely, things that you have to give up, time with family, sometimes working late. Most people start with a W-2 job. I did, and for 2 years, I was essentially working 2 jobs. So yeah, you do give up a lot. You have to put in a lot of effort for it, but it definitely works well. So.
All right, and how did you get yourself? I mean, you mentioned you're going to a local RIAs, but how did you feel like you got yourself educated? Did you get in? You started with some third-party education conferences. How did you learn the syndication process?
I started by just reading as much as I could on my own. I got books. There's a lot of books out there nowadays. Listening to various podcasts, but I always knew that I wanted to get a coach to kind of help me get faster and kind of back to the mental aspect of it. I knew I wanted someone to provide me the mental safety net that allowed me to kind of step forward. These are a lot of zeros behind the projects that we do. So I think I knew mentally for me, that was my personal hang up. That's maybe not for everybody, but I knew what I needed. And that it basically, anything else, you kind of figure out, what you bring to the table, what you can do, what your strengths and weaknesses are. And that was one of the weaknesses I had. And I knew that was one way for me to kind of overcome it, was to go out there and get me a coach that allowed me mentally to go forward. And I did that. So I did end up getting, I guess, a third party education, as you put it.
So when you started and actively looking for deals or starting, what was your strategy? Did you put a team together, or how did you started actively looking?
I think I started putting a team together as that's generally the suggestions. I mean, your team involves your, lender, general contractor, attorney, all that stuff. And I put together my team all at once, or at least I attempted to do that simultaneously. I've heard people say to kind of approach a lender first or general contractor first before they approach a broker, and I don't think it has to be done in any particular order. I think it can be definitely done in parallel, especially if we're trying to kind of compress timelines and kind of move things quicker and scale things quicker. I don't think you need to put any artificial limitations on your processes.
And when you're looking for your first deal, what markets were you focused in?
Well, fortunately, I live in Houston, Texas, and Houston and Texas as a whole is a great place to invest. So my focus was mainly around Texas, the Texas Triangle, which is triangle formed by Houston, DFW, and San Antonio and Austin. So Texas was my main focus. And people always ask if I look in other areas like Phoenix and Atlanta and stuff like that, and those are very strong markets. But fortunately, our backyard's pretty good. So I always like to say, if the barbecue in your backyard is good, you're not looking over the fence to see what your neighbors cook, right? So fortunately, Texas has good barbecue. Our real estate's really good here, so I don't need to look anywhere else.
So how many deals did you get to analyze per week?
I think initially I wasn't analyzing as many deals. One, I didn't know as many brokers initially, so there wasn't as many deals for me to underwrite. And two, being new in the process, underwriting process took a lot longer initially than it does now. But I want to say once I got going, it was probably 10 properties a week. So.
And do you still do 10 properties a week?
Yeah, well, I mean, it's underwriting 10 properties a week. So what does underwriting mean? I mean, that varies, right? So, I mean, for me, there's different levels of underwriting. And that doesn't mean I'm touring 10 properties a week. But generally, I go through different levels of underwriting. Initially, I wasn't. Initially, I was doing deep underwriting on everything because I didn't know any better. And so anything that I was getting across my inbox, I was just looking at and looking at for maybe, the whole day. I might spend 6-8 hours on one deal just to find out that the numbers weren't even close. But I think that's a good process regardless when you're first starting out, because you don't know what you don't know. So it's good for you to kind of look it over and learn from that perspective.
True. Thank you. Good.
And from that point on that you start getting serious, how long did it take you for you to find your first deal as a sponsor?
From the point when I started diving deeply into multifamily and getting serious about it, it took me about 6 to 7 months to get one under contract. And that includes, as I mentioned, all that underwriting, touring properties between my partner and myself, sometimes touring twice. Once you start getting serious about putting in an offer, you might want to revisit again and see if you missed anything the first time. So it takes a lot of effort driving all throughout Texas. But yeah, 67 months for the first one, and then probably about 2.5 months or so to close it once we got it under contract.
Got it. And was there anything in particular on the first deal that, as you were looking at it, you thought, okay, that's the deal, that's going to be my first one?
Frankly, it was just a deal where the numbers worked and the size was attainable. I mean, I wasn't too particular. I was looking for a deal. I had certain criteria of what I was taught, from the educational program I was in terms of what the numbers should be for the investors to be interested in. And then it was a smaller deal, relatively small raise, so it was attainable. So it was a combination of that. I wasn't trying to go after a 300-400 unit deal in my first go around.
That makes sense. So give us a little bit more detail about that first deal. I mean, the location, units, class. I mean, how many sponsors got together to do it?
So I have one partner with whom I'm still with and have done all my apartments deal with so far, David Danko. And so that was our first apartment complex together. It was 68 units in Fort Worth. The tenant profile for the complex and for the area is mainly Hispanic, with the rest Black and some white and Asian. It was a rough area, but we did our research and we felt comfortable that the area was gentrifying. It was moving in the right direction. The city was putting a lot of focus in turning the area, and so we got comfortable with it and we went forward with it. The numbers worked, and I think see what else we had. In addition to my co-sponsor, we also had 6 KPs, key principals, on the deal that helped sign on the loan. It wasn't like, as I mentioned, it was a smaller deal. So my partner and I, we didn't need a KP from the perspective of qualifying from a net worth or qualifying from a liquidity perspective on the lending side. But we had 6 KPs just kind of build out our team and have people working with us for the future. And one of our KPs on that deal ended up being a co-sponsor for us on another deal. So talking about kind of building teams, that was one of the ways that we kind of decided that we were going to build a team, that we decided we were going to work with someone long-term, and these deals are 5-year projections. So, they're pretty long-term, right? They're longer than most marriages nowadays. So, so I think it's very important for you to choose good partners. And so one of the ways that we kind of go through the vetting process of the partnership is that we do have KPs on our deals, and then we approach them generally first for potential, GP, co-GP, co-sponsorship opportunities.
Cool. So on that first deal for you was also the first deal for David?
It was also the first deal for David. And neither of us had actually ever signed on a loan or been a KP for anybody else up to that. And so the conventional wisdom is that you have to have your Fannie or Freddie card via being a KP before you can go and do it as your own. But as in any rules, that there are exceptions, and we were the exception in that that was our very first deal. And so one of the ways we were able to do it is that, as I mentioned, the deal was a smaller deal, 68 units, and it was, I think we bought it for like $2.5 million. So we got it at a very good price. And our raise was only like a little bit more than $1 million. And so between our net worth, I think our net worth was, 3-4 times as much that was needed. And our liquidity was like 10 times as much as was needed. So the lender was comfortable from a balance sheet perspective of giving us this deal. And their only requirement, since we were first time and didn't have experience, is that they wanted us to kind of have a bigger equity stake in the deal. So they wanted us to each have 10% of the equity. So that's what we did.
Okay. So thinking about those people that are starting to look for their first deal, or they're setting up everything to go look for that first deal, what would be your best advice for those people to start doing that?
I would say get educated and then get active. You can't, I don't think those things kind of go hand in hand. Too many people get educated and then don't do anything with it. And too many people jump in head first. But I would say, yeah, get educated, get active, go out there and do things. I mean, this business is not one for you kind of sit back inside your office behind a computer. You have to kind of get out there, meet a lot of people. You have to meet brokers, you have to tour properties, you have to meet potential partners, meet potential investors. So you have to get out there, put yourself out there. If you are not comfortable, then frankly, you just have to kind of get comfortable and teach yourself to get comfortable. And I think there's a lot of introverts in this space, and you wouldn't know it. They come home after a networking event and they might be tired of having to work with everybody, but they still manage to do it very well. So I don't think there's any excuse for anyone that says they don't like to go out there and meet people. Or if you truly are that way, then you need to find a partner that can kind of fill that role for you, right? Because as I mentioned earlier, you kind of have to figure out what your weaknesses and your strengths are, and figure out how to bolster that, whether that's you can improve yourself or you can go and find a partner that can fill that for you. And kind of stepping back and talking about my partner, that's kind of how I started out. I had a W-2 job, and time for me during the day was limited. I had time to sit behind a computer to do some stuff to an extent, but I definitely didn't have time to go and tour a property in another city 4 hours away in the middle of the day. Especially, I had my own consulting company. I couldn't afford to take that time off. So in that sense, I partnered up with someone that was full-time and had the ability and the flexibility to do that. So I think everyone needs to kind of look at themselves and figure out what they need, and then go out there and find partners to help them fill that role.
Okay. What about any recommendations or techniques that you would give aspiring sponsors on quick analysis of like your initial underwriting to not go into deep?
I would say that maybe initially you probably should go into deep underwriting on every deal as practice, because I mean the likelihood of you winning your very first deal is low. I mean, I'm sure it's possible, but I would say make sure you understand. Don't do any shortcuts initially, though it takes up a lot of time. Your underwriting is going to go slower, but I think it's good. But eventually, you'll get quicker with your underwriting. So nowadays, the way I do it is I go through what I call the express analysis, which is I have my spreadsheet where I plug in all my numbers, and I go in there with the assumption that everything that the broker told me in terms of the numbers, in terms of the rent growth and expense cuts and all the other stuff that they say can be achievable, I assume that is the truth, and I put that into my spreadsheet and see if it works or not. And that's a process that should only take 10 minutes or so. And if the numbers aren't even close, and with the broker's kind of optimistic, if you say, or just outright fake sometimes numbers. But if the numbers don't even work that way, then I don't go any further, and I've only wasted 10 minutes of my time. But if the numbers are close enough, if either they're enough or they're close enough in the sense that if I'm looking for a deal that gives me a total return of 75%, if I can get to 50%, and I think I can look deeper and maybe squeeze another 25% from something I missed in the underwriting, then I'll look deeper. So
good advice.
Okay. Awesome. So also on tips for new aspiring sponsors, what type of opportunities do you really look for on reducing expenses and increasing revenue on those properties you analyze? What are like your pet peeves, preferred options for those two, for expenses and revenue?
Well, I mean, for revenue side, I generally look to see in terms of how they do the utilities right now, opportunities to kind of build back on the utilities. Obviously, if the property is all bills paid, and to see whether or not that is something that you want to keep as an all bills paid property. Sometimes you do, sometimes that might be your competitive advantage. My very first property, for example, was an all bills paid property, and we kept it all bills paid the entire time because we didn't have any other amenities at the site. They had a pool at one point, it was filled in. There was no playground. We had a laundry room, if you can call that an amenity. But beyond there wasn't really anything. So we wanted to kind of stand out from the surrounding area. And so we kept it all bills paid to make it more attractive to the tenant profile that was at the property. A lot of our tenants in these type of lower end C minus type properties, they have fixed incomes and they don't like to have variable expenses. So when you have when they're paying individually for electricity and water and stuff like that, that can hurt them even if it only goes up $50 for that 1 month. So they knowing that the rent's at a certain amount every month is a big tool to kind of bring in some of those type of tenants. So I looked at from income perspective. Reserved parking, we ended up implementing that on multiple properties. Laundry, I mentioned laundry, that's income right there. And then on the expense side, I like to look at water. Generally, I have an idea of what water should cost per unit for these type of aged properties. And so I'll look at the underwriting and see if their water is at, say $100 a unit a month. And I think that they should only be operating at $40, $50 a month with the proper water conservation implementation. Then there's a big gap in terms of the water bill that you can save and increase the value of the property.
I have a question. Oh, sorry.
No, go ahead.
I was just going to ask, in terms of adding value, when you went in, what was the process of raising rents if you did? Like, how long did that take, and how much did you raise them by, and how did that affect your occupancy in that area? So
for that first property, I think our guess in terms of the area turning and the strength of the area, it worked out well. We did go in there, we did probably implement, I think on average, I think we had like $5,500 a door for putting into the property to fix it up. Now that part of that was we painted the outside, fixed the carpentry, and redid the parking lot, etc. And part of that's on the interiors. On the interiors that we did, we probably put in, I would say maybe about $4,000 a door to put in new flooring and doing the painting and plumbing fixtures and light fixtures, etc. And we were able to get on average $125 a month rent increase.
Wow.
So
wow.
Yeah, so I mean, on some they were higher than that, and some of that were lower than that. It just depends on where the leases were at the time that we took over the property, but they were pretty significant bumps, and there were pretty much no impact to our occupancy. We stayed in the mid to even high 90s pretty much the entire time that we owned the property. So it was a very strong area. But yeah, we were able to do that. And so it's a combination of you kind of implementing your business plan, and then a combination of just being lucky, right? So you're lucky, you get the tailwinds of the market. There's a lot of job growth and population growth. And, but if you find a property that is under market, you do your market analysis and you find it truly under market, you should be able to push rents.
And so, Michael, now that, I mean, it's been some time since you did that first deal, and if you were to go back in time with the experience that you have today, is there anything else, something that you would have done differently in terms of that first deal? I mean, different team, different strategy. Because I know sometimes what I see is, as a new investor, and they're spending time and time again looking at deals, sometimes they start getting more aggressive, sometimes they're getting patient. So is there anything that you would have done different on that first deal?
On that first deal, I think we did pretty well on that first deal. So it's kind of hard for me to go and say I would have done too differently. I'll throw out a few things that we did. I mentioned that we had a lot of KPs on the deal. One of the other things that we did, I mentioned that it was a smaller raise, and one of the things that we purposely did was that we lowered our investment requirement from 50,000 to 25,000. And so we did that on purpose because we're thinking about the future. So we wanted to kind of build a team. We wanted to build a base of investors, and I didn't want, just to have 8 or 10 investors. I wanted to have as many as possible because I was planning this deal to be a home run, and I wanted as many investors to go out there and tell people how great we did on this property. So we had people come to us and wanted to invest 100, 75, and 50, and we pushed every one of them down except for 2. One of them started at 100 and we said no, and he said, how about 75? And we said no, and he's like, you got to give me 50. So then we're like, okay, we gave him 50, and there was only 2 investors that were at 50, but everybody else we pushed down at 25, and that was that was something that we did on purpose to make sure that we could have as many investors as possible for a first deal. So I mean, I would say kind of think about your goal as a whole on your first deal. Be flexible. Just to give you an example, this is the deal that I lost out on, but barely. It was actually an off-market deal in Beaumont, Texas. This was actually the very first deal that David and I worked together as a partner and put in an offer on. And in the end, off-market deal, we negotiated. We were away by $100,000. And I refused to go up that extra $100,000 because it would have, quote, only been 98% total return and like 11% cash on cash. So because it didn't hit the 100% mark, that was my delineation. I said, no, we need to be 100%. And I mean, we would have bought that property for something for like 38, 39 a door, and they're selling for like 75 a door now. So, it's one of those things where, okay, I had these very, very strict criteria, and I just, and obviously it's good for you to have criteria and underwrite against something, but maybe be flexible and think about it holistically and see, all right, this is quote only 98% return, but I'm giving a very solid 11% cash on cash. Maybe that is sufficient for my investors, right? So that'd be one advice I give to.
Good.
All right. And so once you got that deal under contract, can you talk us through the stabilization process? Because there's a lot of emphasis on getting the deal, but now after you got that deal, so was that, I mean, changing the property management? Talk us through that process of stabilizing that first deal and how long it took, and any issues that you or unforeseen
it
things
can be
that
tough
happen.
because, like you said, a lot of times, you learn how to buy a deal, you learn how to close a deal, you don't necessarily learn how to operate the deal. So that was a big learning process for us, and then certain expectations that we had coming into it, and we thought, okay, we're getting a third-party property management company, but we still don't really understand what that means at this point. What does it mean to be an asset manager? And if you get, our property management company, they didn't really have a good onboarding process. They, first-time owners, we were thinking, okay, maybe someone will hold our hand, or at least maybe we were just being hopeful and being ignorant about the matter, but there was no one holding our hand, and we didn't really know. But a lot of times the property management companies weren't doing a lot of the new onboarding stuff that they should have done, getting utilities switched over from the previous owner to yourself. Those sort of things didn't get done properly, and we learned later on to follow up on these sort of things. But that's a tough process when you're first taking over a property for the very first time. So that kind of goes back to the networking aspect of get out there, meet a lot of other owners and sponsors, and that's what we ended up doing. We end up, because we invested, both David and I, we invest very actively as passive investors. We had a lot of people we could reach out to and get advice from, and that's what we did. We'd reach out and say, what do we need to do? And they kind of gave us a list of things to go through. And we went through them and realized, oh, okay, these are things maybe our property management company should have done on their own. But as asset managers, in the end, you're the one responsible for it. Your investors are not going to take kindly for you to pass blame to the property management company when in the end that they put their faith with you, right? So, but fortunately, we were able to get over that, and we were able to get the property moving along pretty quickly and stabilize pretty quickly. I don't think we ever dropped into the 80s, so we stayed stabilized the entire time while we were doing all the upgrades and moving things up. So, as I mentioned before, when you have the tailwinds of the market helping you out, and when you also work hard and act quickly, that helps.
All right, excellent. And when did you, how long did it take you to start looking at your next deal? Now that you, have you always continued looking at your next deal, or did you take an approach of, let me stabilize this one first and then look for my next deal? Talk about the process of getting from the first deal to your second.
Yeah, so we weren't really looking too much at that time. Because as you said, first deal, you kind of want to take your time. But in that situation, our broker that sold us that deal then approached us just a couple months after that to kind of, they had a new deal that they thought was a good fit for us. That's what brokers will do. They'll get a deal in and they'll pull up their list of contacts and figure out who fits what. So if they've got a new 500 unit deal, they know that it wasn't for me, but in this case it was a deal that was just a little bit bigger than the one that we had just recently closed. So then he approached us on that one and pushed us to go and tour it. So we weren't actively looking, but it was pushed to us and we took advantage of it. So nowadays, while we have a deal in the middle of closing, sometimes we'll kind of start keeping our eye open, not actively underwriting. I mean, this time around, I just closed on a deal a month ago, and I'm just really starting to underwrite and tour properties again. So it's about a month or so after I've closed, and I'm only just starting up now. So sometimes it depends on how much work that the deal has to do. If you have a lot of work and it's going to take up a lot of your time, especially if you still have a W-2, then it's probably behooves you to kind of take a little time. But both my partner and I were both full time, and so we were looking to do 3-4 deals a year. So then we kind of overlap the process a little bit in terms of when one is closing and maybe start looking at the next one.
So tell us about the process of the transition between your W-2 job and becoming a full-time multifamily investor. How long did it take, and when did you took that decision of quitting your job?
Yeah, so I guess from the time that I started multifamily, it was about a little bit less than 2 years, something like maybe 21 months between that time to going full time. And I guess you can add 2 years if you want to add my single family into the mix. But yeah, at that time, I think this was last I went full time last September. I made that decision last August 2018. And at that time, I was in the middle of closing 2 properties at once. I had my 4th apartment under contract for purchase, and I had the very first one, my first deal that we're talking about here, on the market for sale. So I was in the middle of 2 closings, and I ended up selling it last September, and then I bought my 4th one in October. So it was around that time I decided, okay, I've proven to myself that I can do this. I've proven that it's not a fluke, and that I have momentum on this. And I just felt that if I could do this in the amount of time I did with a W-2 job, I wanted to see what I could do full time. And so I decided to take that jump. I had money coming in from the sale to kind of give me a little bit of buffer. But I jumped in there to see what I could do full time. So, and it's been great. It's been a great year.
So I know we already talked about the markets you invest in. Are you planning on staying here in Texas, syndicating, or do you want to go elsewhere?
I would say primarily, I'm probably going to spend 85% of my time in Texas, in particularly Houston and Dallas-Fort Worth, probably. I'm interested in a few other markets. I mentioned Atlanta and Phoenix earlier, Jacksonville, Florida. Those markets I'd be interested in if there were strong partners I could find out there that I'd be comfortable with. But for the most part, right now, the focus is on Texas.
Okay, good. And how are you preparing for an eventual downturn on your underwriting?
I don't think we've changed our underwriting too much. But I would say get as much data as you can. Read, try to get a feel for the market as much as you can. I go to a lot of conferences that has, economists that speak and talk about where they think we are in the market and what the market does. I read so many articles on a daily basis. My partner does too. So I think getting data and understanding and making sure that you can, move with the market as you need. In terms of underwriting, we do sensitivity analysis. We underwrite to see what happens if we don't get the rents that we think we can. We underwrite what if our occupancy drops a certain amount. We underwrite different reversion exit cap rates. So we build that in. We build some buffers into our numbers there. Sometimes we look at deals. We get I mentioned water conservation. So a lot of times we don't use the full number that the companies give us in terms of what they think that they can cut our water bill by. So we kind of build in some buffer that way.
Interesting. So the education is part of your strategy of protecting against
ongoing education. Yeah, exactly. Yeah. And new education, recent education.
Good.
I've been to so many conferences this year, so I'll be in LA three times this year.
Wow.
Already, so.
Good.
Are you just keeping with the term of the a potential change in the market there? Are you doing anything in terms of financing, like maybe not considering bridge loan, or maybe taking different leverage? Are you taking any different approach from a financing perspective?
Yeah, actually, I am, and I've done that on my most recent deal too. I don't have anything against bridge loans. I think bridge loans, if for the right property. So that's really the caveat right there. A bridge loan, a lot of people think bridge loans are risky in this current, part of the cycle. And I agree, but you can counter that with the right opportunity. If it's something that you're getting a bridge loan just because the numbers don't work otherwise, then I don't think that's the right opportunity. But if you get a bridge loan for something that you really can truly add a lot of value to, I don't think you can, bridge loans probably don't work for a deal that's already stabilized, unless the stabilization truly is just from the perspective of occupancy. If they're truly, hundreds of dollars under market rent, then maybe you can argue that. But other than that, I think a bridge loan maybe is for something that's, doesn't have the right occupancy, 60, 70% occupied, and you can turn it around that way. But in terms of lending for our most recent deal, for example, we were very particular in terms of the type of prepayment penalty that we chose for the property. And so, by default, a lot of the prepayment penalty for the type of lending that we get from the agencies, Fannie and Freddie, or yield maintenance. And so we paid for step down prepayment, which is a more, that's something that you can predict from the beginning. And we had to pay an extra 20 basis points, so 0.2% higher in terms of our interest. And then on top of that, we bought down the step down further. So the initial step down would be maybe years 1 through 3. It's a 5% of the loan amount in terms of prepayment penalty. So that just buying that from the yield maintenance down to that was 20 basis points. And then for another 20 basis points, we bought that from the 5.4321% to the 3.21%. So we would start out at most, we would pay 3% in terms of prepayment penalty. But by year 4, we would already be down at 2%, right? So that was another 20 basis points. So we were paying 40 basis points higher than what we could have gotten. I think our initial quote was 3.92%. So we were sub 4%, but we ended up paying 4.32. And we did that because we wanted the flexibility. We thought that maybe we could probably increase the value by quite a bit for this property that we just bought. But because of where we are in the market, we wanted to kind of hedge that risk doing this way. So that would give us the flexibility that if we could sell it after just a few years, we could do it with a set prepayment penalty that we were comfortable with. And if we didn't sell it, we could always refinance it. Or if we decided not to, we would just hold on to it for the full term of the loan. So it gave us flexibility. And I would think that was kind of part of our goal in this stage of the cycle.
Yeah, makes sense. So what kind of tool or book or podcast would you recommend for somebody who is starting now, somebody aspiring to be a syndicator?
Podcast wise, I mean, I like Old Capital a lot for the content, and then I like Rod Cleave's Lifetime Cash Flow for his focus on the mental aspect of real estate, and maybe because it resonates a lot with me from the mental side. So that's why I think that was definitely my holdup. Maybe not for some people, but for me it was, and so that helped me get over it a lot. And then doing what you're doing here, these meetups, virtual or not. I think meetups and RIA, for me, I'm a huge believer in networking. That's why I do it a lot, and I find a lot of value in it. So I would say for people starting out to kind of get out there and be around other people, the energy that you get, anybody can, you lose motivation if you're not around this. You kind of fall back into the same old habits. And getting out around other people that are kind of doing things kind of gets you going. It does for me. So anytime I get out there and I see people doing things, it keeps me going. So.
Great.
All right, excellent. So with that, I'd like to maybe spend the last few minutes here and see if there's any questions from the folks here. I know, Clayton, you've been pretty quiet today. I don't know if you have any questions or anybody else who wants to ask something.
Clayton's in an airplane.
Yeah.
Oh, he's flying today, right?
Yes.
Yeah. The meetup is really good when every week you have someone on a plane.
Yeah.
And I think David, you mentioned that you have a question. So you were saying, where does Michael think we are in the market in Texas, and he's in Austin?
I think Texas is in a good spot, and I think where we are, I think it depends on which city too. I mean, I'm in Houston. I don't think we're in the same part of the cycle as Dallas is. Dallas has been going strong for a long time, and maybe it's further along in the cycle, and Houston's been hindered. 15 and 16, we had the oil and gas downturn. 17, we had Harvey. So I think the cities are maybe in a little bit different parts of the cycle, but overall, I think Texas stays very strong these upcoming years. That's my personal opinion, and just kind of putting together. I mean, for me, I go to the smarter people, and I kind of consolidate the knowledge that I gain from them, listening to a lot of economists and stuff like that. But I mean, in the end, I think you can read. I mean, I think they said the last economist I saw said that, Dallas is getting another 43,000 people moving in next year. Houston's got 55,000 people moving in next year. Overall, we have, I think, something like 90,000 people moving in just from California to Texas. So there's a lot of growth here for various reasons. And I think that if there's any sort of upcoming slowdown or downturn, I think Texas is going to, at the very least, weather it well, or maybe even benefit from it, because people are going to flee to where there's jobs. And of course, that generates population growth, but people go where jobs are right now, that'd be Texas. Texas is where the jobs are. So I think that might even help us. But even if we have a downturn, what does that mean? Everything's hyper local. So downturn is to what extent? Maybe the downturn is that we have a plateau instead of a dip, or we have a dip, it's a dip for 6 months to a year. So we don't really know what that looks like. Everyone can guess right now. But overall, I feel pretty bullish about Texas in general.
Right.
I did
And
see
the
the
next
question there too.
Yep.
Yeah. Go
Yeah.
ahead and read it.
Yeah. So the other question is in terms of the weather in Houston, and if that affects your decision to invest in Houston.
It's a big factor for sure. Insurance here, but that's Texas in general. I mean, that's not just in Houston. That's in Dallas. Maybe not so much as in San Antonio and Austin, but Houston has the hurricanes and the flooding that comes with that, and North Texas has hail, and so you have a lot of roof damage up there. So insurance across the board is a big factor. It's gone up a huge amount. I just got my quote for my property up in Wichita Falls, and it just made me gag. I mean, it's painful. It's really painful. But that's down here in Houston too, with the flood insurance and whatnot. And then property taxes across Texas has been very painful too. I mean, we file lawsuits for every single one of our properties to try to fight it. But that does make it harder to invest in Texas for sure. So you have to make sure the numbers work. That's why a lot of deals nowadays don't work, primarily because insurance in Texas. So.
There's another question from Clayton, and he says, your deals to date, how did they contrast in amount of interest only negotiated, and how do you find that the lenders are more flexible with you now that you have proven track record, or is it more dependent on the individual asset?
I think primarily on the asset. They'll underwrite it, and if it gets to a certain amount of, if you're not debt limited, then they'll give you higher leverage, and if you got room above that, they'll give you additional IO. I think a lot of times the lender will quote you the best case scenario, and that's definitely something you need to be careful of. You get these term sheets, and they show you everything. You get full 80% leverage. You get 4 or 5 years of IO, and then when it gets down to it, they'll come up with one reason or another. We thought you had a stronger team, etc. And you might end up losing that leverage and that IO somewhere down along the line. So, so you might end up getting the term sheet as if you were the super experienced sponsor, but you might not end up getting that in the end. And one of the things I remember asking a lender one time when I was trying to find a deal here in Houston, and Houston's a pre-review market, which means that they start you at, I think, 60 or maybe 65% leverage, and then you have to kind of fight up to a maximum 75% leverage, but you can't get to 80%. Whereas another market like Dallas, you start at 80%, and if for one reason or another they might cut you down to 75%, but you kind of start at 80. So, and I asked the lender, how are these other, big sponsors out there doing these deals, at these rates, at these leverage? And he's like, well, they don't want that high leverage. They want the lower leverage. So everybody approaches it differently. They come in there and they have a different purpose. They have different type of investors and different goals for their investors, and they want lower leverage deals. So I don't know where I was going with that, but that was something I remembered.
Good. We have another question from David Ashby. So when you were raising capital for your first syndication, how did you handle questions about previous experience from potential investors?
Yeah, that's a good question. I think one of those things that is one of my pet peeves when I go out there and I either meet people or I see people talk online and they say, hey, how do I find a syndicator? And then you got the guys that have done 10 plus deals. They'll come out there and they said, oh, well, the number one thing is to make sure the syndicator's got a track record, right? Well, it's great now that you got 10 deals under your belt that you say that, but what about for the guy starting out, right? So everyone wants to kind of tout that. I mean, I have the experience now, and I think it definitely does matter, but I hate it when people just say, oh yeah, make sure that they have experience, because everyone has to start somewhere. So one of the things that we leveraged from our perspective is, I had my own company that I ran for 12 years. So we leveraged the ability that my partner, David, he's done, a half a dozen startups in his career. He still owns 2 companies in Moscow. So we used our business experience, whether that's from being a business owner, or that's being an executive in the corporate world. I think those are all skill sets that you can kind of show that is, transferable to this space. And then obviously you can always partner with people and they can bring different levels of experience. And together as a whole, I think that you can put together a strong team without you having a first deal immediately. And then the other thing is part of being part of an investment group like we're in, that helps too. And that kind of helps you kind of meet people and get that level of comfort. And that goes back to what I mentioned earlier about me being a big believer in networking. You got to go out there and meet people and get yourself, be open and transparent, and then put yourself out there that people who know who you are and feel comfortable who you are.
Interesting.
And would you say that doing the first deal, like with 2 new syndicators like you did, is that an approach you would recommend for somebody today? Or would you say maybe to avoid that same question, maybe on their first deal, maybe partner with somebody who already have a track record?
I definitely think that's a viable option. I mean, I think both ways can be possible. I think nowadays it's harder to find deals that you could probably take down by yourself as a first-time sponsor, just because of where we are at in the cycle. Even finding a small 60, 70 unit deal is going to be a $5-6 million deal nowadays because of where the pricing is for the properties. So just because of that, it's probably a slightly different market than where I was a couple years ago. So at that time, we were paying, 34, 35 a door, and our balance sheet was strong enough by ourselves. Nowadays, it's not the same anymore. So yeah, I would say go out there and meet people and bring in experienced sponsors to kind of help you take down your first deal.
All right.
Good.
Does anybody have any other final questions before we wrap up? Okay, there's one more here. Martin, do you want to take that one?
Okay, so David Ashley is asking, we're at an all-time high in rent growth in most of Texas areas. How are you projecting rents in your underwriting in the future? Last one, sorry. That's fine.
Yeah, in terms of rent growth, for the most part, we are underwriting kind of just a 2% kind of just inflationary, meeting inflation rent growth past our first year. For our first year, we'll underwrite something that's more in tune with where the current property is at, and then where we think we can get it to within that first year and a half or so, however long we think it takes for us to kind of turn the property. So if the property is $100 a unit under market, then we'll underwrite that will get to that $100 to get it back up to market. But going forward beyond that, we don't underwrite a huge amount of rent growth. I mean, obviously, Dallas and other areas in Texas has had huge rent growth in these last 5-6 years, but we don't anticipate that to be the case, and so we go down to just 2%, and then I subscribe to CoStar and we look at that and we see what they think that the area is going to do, and then if we need to be, then we'll dial down and make it fit that a little bit more. They're what they predict on that side, and then but yeah, that's basically it.
Good.
All right.
I think we don't have any other questions, and I think we are done with the time. So thank you everyone for joining.
Yeah. Yeah, absolutely. So I just want to share one more time here the email from Michael. Michael has been very gracious with his answer. And he said, if people have any additional questions, it's michael@bayoucitymultifamily.com, if you can see the screen. So thank you so much, Michael, for spending the time with us. And I also wanted to share a couple of dates for our next online meetups. So the next one is on third Wednesday at 7 p.m., so which is November 20th. That one, we're going to be focusing on going from getting your first passive deal. So what are some of the criteria and some of the things you need to be careful in selecting and making an investment as a passive investor. And then we're back on the first Wednesday a month from now on December 4th, which is then 0 to 1 for syndicators again.
Thank you for watching this week's episode of the Multifamily 0 to 1. Join us live the first and third Wednesday of every month.